He runs the value-based ETF ZIG and the deep value micro ETF Deep. He's somebody that taught me so much about investing through reading his book because he simplified it in a way that even a dummy like me could understand it. So I'm super happy to have him here, and we'll see what he can teach us. If he can, help all my audience learn a little bit more, and hopefully help me, most importantly.
Thanks for having me, Tony.
So, Tobias, first things first, actually, I'm going to start things a little bit differently because you've had great investing podcasts like Investing with Tom and so many other great ones that, they get into the deep nitty gritty of investing and they do a much better job than me digging down that path. So I'm actually going to ask you from a different direction. I'm going to try to tell you a little bit of my story and how I jumped in, and then we'll kind of work out through there, maybe things that you're thinking I'm doing and things that, how you change and ways that you change your way of thinking and investing and things of that way. Just
cool.
To take it from a different direction. Okay, so I'll get into this. So I'll start my story. I was a former UFC fighter. Around after I got cut from the UFC after a couple fights, and I was kind of figuring out my way around life. I had a friend of mine who was invested in cryptocurrencies, and he had made an enormous amount of money. But at this point, that enormous amount of money had become a lot smaller because, the ebbs and flows of it are ridiculous. And so I didn't know anything about investing. I was just trying to build my own business. I had a little bit of money for my fights. And he was like, listen, I need to buy a couch, but I don't want to pull anything out of my crypto because, the markets are super down and whatever. So I was like, yeah, here, I'll give you the cash. Just give me a piece of your portfolio, whatever it is. I don't care. Whatever, he was one of my best. He's still to this day because of one of them. But yeah, I give us just, let it go and let me know. So a year passed. I was running my own business, a personal training studio. Over that time, I left for vacation and I learned something about business. My first big lesson that I didn't really have a business, I had a service, because once I left and I came back, all my clients were like, oh, they had other trainers. I had to rebuild from the beginning. So I started panicking. And this is around 2016. And my friend's like, why are you so freaking out? What's the big deal? And I'm like, man, my clients aren't there. He's like, man, you have a lot of money. I'm like, what are you talking about? He's like, you remember that money you gave me? I'm like, yeah. He's like, yeah, it's 100x since we did that. I was like, wait, what? I'm like, that's insane. And I was like, man, I gotta learn about what's this investing stuff. So I tried to get into cryptocurrency. That was I just started to get, it was way too confusing for me. It was way out of my ballpark. I'm not a computer scientist. He is. He explained Bitcoin to me, and as an idea from a complete, noob, I was like, okay, this is interesting. But so I was like, oh, let me see who the best investor in the world is. And I looked up Warren Buffett, and Warren Buffett came up. And I was like, oh, okay, so I'm going to do what this guy does. This is a good idea. So in the beginning, I didn't have enough money to really invest. I was really investing just in my business, trying to build up. And I ended up getting into this business as being a trainer on retainer, as my wife calls it, which is I travel the world with very high-end clientele, and I work exclusively for them, normally for an allotted period of time, even though now I'm basically permanently with two clients. And then I started investing, and I tried to figure it out. And during that time, I saw Warren Buffett, and I tried to copy his trades. That was the first thing I did. I was like, oh, Warren Buffett has Apple, I'm going to buy Apple. Warren Buffett has this, I'm going to buy that. Warren Buffett owns Berkshire Hathaway, I'll buy some Berkshire Hathaway. And that was
a good approach.
It's not the worst approach, I was like, I don't figure this out. And then just out of pure interest, I was trying to figure why he came up to these conclusions. And as I started digging into this, I was like, wait a minute, so how do I figure out what is this intrinsic value that they're talking? And it really stressed me out, the idea that nothing was certain. Like, it's like, oh yeah, well, we're basing this on this estimation, on this discounted cash flow. So if it grows at this for 10 years and this, I'm like, well, how the fuck do you know it's going to do that? Like, I don't know. By the way, we curse on this podcast. Feel free.
Yeah, that's all right. Me too. I'm a civilian, mate.
Yeah, exactly. I was about to say, just be a comment free. Yeah. But yeah, I was like, I'm like, well, how do you know? It just doesn't make any sense to me. Like, you're just guessing. Like, obviously, we're just guessing here. Like, even if I can have an understanding, like, I'm very comfortable to believe that Coca-Cola will be around in 10 years. I highly doubt anything's happening to Coca-Cola. But will it grow? And how much will it grow? And it will be as much as my cost. Will it be worth my cost of capital? So for a while, I gave up completely. I just bought the index. I was like, this is too much for me. Just started putting some money into the index. And that's when I picked up your book, The Acquirer's Multiple. And during that time, I was like, when I was reading your book, I'm like, this makes a lot of sense. Like, it's a little simpler. There's not so much guesstimation involved. You know, I felt more comfortable with the idea of like, yeah, I'm taking the entire enterprise of the business and I'm seeing what its cash flows are. If it has good cash flows, it's cheap enough. It's a cheap business. Like, and if I get a basket of these, as long as Tobias is back testing, it all works out. I just trusted that it did because I couldn't do it myself, obviously. I was like, this makes a lot of sense. And that's kind of where I was. And as I started getting into it, I struggled. I started trying to add these into my portfolio. And I started getting like nervous at the volatility of this business. And at that point is when I'm like, all right, my clients were making fun of me. They were calling me Warren Buffett. They were like, oh, Mr. Buffett, look at Mr. Smart Guy, our personal trainers, this guy. So during that time period, while I was trying the Acquirer's Multiple, I was trying to build my own basket. I basically did it myself. I used your guys' website. I signed up. I saw the 20 of the top ones, and I was just trying to do it systematically. But I was getting crushed. It was just during the 2021 when everything was just flying to the moon. My crypto, which I just capped, was I was worth like quadruple what I'm worth right now. But and I was thinking, like, I have a good stomach. Like, it doesn't really bother me so much. But I kind of got bothered because my clients were busting me out, like, oh, where's your portfolio at now? They had all these other fund managers that they had invested money with, and they were making money, and they were like, oh, that shit doesn't work. Value investing's dead. Blah blah blah. So I'm like, look, I don't want to just trust Tobias anymore. I need to like figure this out. I need to understand this deeper. So I signed up at the Columbia Business School, and I found out their way of valuing company, which is something I do want to ask you what your opinion is on that. And basically, I started valuing companies, and at some point I found a company that I thought was very cheap. Over this time, I sold out of all my Acquirer's Multiple. I kind of started from scratch. I kept a couple really good companies, blue chip companies. I figured in my mind they were like the S&P 500. I set them off to the side. And I was like, I'm going to start from scratch. And I found Meta at the time had dropped significantly. And I was like, well, this company, I don't see anything wrong with this company. Like, I don't know, everyone's saying it's dying. I don't see that. It's growing monthly after users. I understand this business. I've used it for my own business before. It's still something if I had, and I am opening another business now, so I would use it again for advertising. That doesn't make any sense to me why this is happening. I bought that, and as I did it, my client was like, what are you doing? What are you buying? I said, man, I think you should buy Meta. I think it's a good bet, And he bought it, and it was just one of those momentum things, My style, obviously, because I'm trying to be a value investor, especially, at the time, I was like, I wasn't planning on selling Meta. I was just planning on buying it because it was cheap. But he bought it with me, and at a much larger position because he's obviously much more wealthy than me. He put a big position in, and it shot up. Just some momentum swing shot up, and he ended up making. I don't want to disclose him up because it's his money, but he made a lot of money, and he's like, "What should I do?" I said, "Listen, it's probably going to go back down. The market's really volatile right now, but I'm holding it for the long term. But it's probably going to go back down soon. If I had to guess, I said, I'm not a magic bulb. That's my guess." And so he sold it, and then it crashed. He's like, "Do you still think it's a good buy?" I said, "I still think it's a good company. You should buy it and hold it." He's like, "I'm going to buy it." He bought it. It shot up again. He sold it again. He made a whole bunch of money. Then they were convinced that somehow I'd figured out the secret sauce. Right? Even though I told them I had not figured out the secret sauce. And they're like, "Listen, we're going to give you $500,000. You have a fund now. You go to make us money. Go do what you do." And I'm like, I am not prepared for this. like I'm just learning. And then over that time, I started valuing companies, and it's funny how I slowly come back to an acquirer's multiple over the time now. I started over in the acquirers, basically there, the acquirer's multiple all the way around. Now I'm kind of back there. So I'm like, now I get it. Now I really like it's solidified to me. Like I understand why we're doing what we do. I understand why Tobias likes to torture himself and buy these things. Now I understand.
Yeah, that's great. That's a good story. I had a similar kind of thing that when I was in university, I did law, and a buddy of mine said, Warren Buffett is the richest person in the world, and he owns an insurance company. And I was kind of like, well, I don't want to be I don't know anything about insurance. I don't really want to work in insurance. I don't want to learn that. It's kind of like, lots of people who are super wealthy have been entrepreneurs and they've started a business, and like that's how they get really wealthy. But Buffett is different because he's an investor first, and he's sort of coincidentally he owns a big insurance company because he's kind of worked his way into it from having, he buys Berkshire Hathaway when it's like making woolen and worsted kind of, it's like a, what do you call it? Fabric.
Yeah,
it's a fabric maker.
Yeah.
But it's even then, in like 64 or whenever he got control of it, like even then there were cheaper places in the world to make fabric. And the first thing he did was buy an insurance company because he likes the float, which is like, you write a contract and you pay the money, the customer pays the money up front, and then you hold on to the money for like whatever, a year or until the contract runs out. And if nothing happens over the course of that contract, you just keep the money, but you got this matching liability on the other side. And so when they've got that pool of money, he can invest it, which is what he was doing. So he uses it as a sort of form of leverage that's not recourse to the business. So it's really clever. So it's worth understanding insurance for that reason. But insurance is really hard to understand. Like even now, it breaks my head kind of getting into it a little bit. But he said, you should read, my friend said, read Buffett's letters because they're free. They're on the internet. You can learn, that's the best MBA business education you're ever going to get. Better than anything you can get at any other university. And it's free. Like just go and read it. So I read through it. I've read them, I don't know how many times I've read them now, 20 times, something like that. Every time I read it, I realize that I missed something. Like I read it and then I go and learn some more stuff. And then I go back and I read it again and I'm like, oh, there's Buffett talking about it in like 1983. He figured that stuff out years and years and years ago. So for me, it's like, that's kind of Buffett's where I'm aiming for. But then I'm kind of like, Buffett sort of talks about the fact that you don't need to be a genius to do it. You just need to have a good temperament. And what he means by that is if you make up your mind, you do the work on something, it's not that hard. Like the thing that trips people up is they try to do stuff that they like valuing insurance from the start. That's hard because you don't have any kind of context. You don't have anything else. You're better off finding a simpler business. Like Coke is a great simple business to value. So you do your valuation on Coke. Coke's been really expensive most of the time that I've been an investor, so I've never really been able to own it. But there are other like examples of things. And once you start doing it, you realize that what you want is something that's undervalued. And really what you want is something that stays undervalued. And that breaks a lot of people's brains because they think what you want is you want them to buy it and you want it to go straight up.
Yeah.
But that's not really what you want. Like if you're in these things where you've got a good manager who's a Buffett type manager who, when the stock gets cheap and they'll buy it back, if you think about it, you want that stock to stay cheap. And there are good examples. Like the Motley Fool used to run these ads all the time where they contrasted IBM, which for a long time was like a high-flying stock with a very high PE multiple, and it was growing really fast. And then they contrast it with Tootsie Roll, which was, it's candy. It's, who cares? Like it's pretty boring. It's not growing very fast, but it's owned by the family that kind of founded it still. And so they run it for cash and they want the money out of it. So they run it really lean. It's got huge returns on invested capital. And they basically pay out all of that capital either by buying back stock or by paying dividends or whatever. And they don't go and do stupid acquisitions. And so when the stock gets cheap, they just buy it back. And so you're just along for the ride with this family as they're buying back stock in this good business. And the Motley Fool ad showed that over a really long period of time, Tootsie Roll had outperformed IBM when IBM was the absolute, the hottest thing in the market. And it's kind of hard to figure out why unless you understand those little mechanics. There's not a lot you have to understand. You've got to be able to work out how much cash is this thing actually generating over the course of a year that it's returning to the business. And then what are they doing with that cash? Are they buying back stock? Are they paying a dividend? Are they buying stuff? Some companies are very good acquirers, so you want them buying stuff like Constellation Software or Berkshire or those kind of companies. Most companies, though, they've got a really good niche. There's just not much that's kind of comparable to their niche, and they get in trouble when they try to expand outside it. You just want them staying super lean and returning capital. So you just have to understand the nature of the business a little bit, get a rough idea what that business can do over the next sort of 3 or 5 years, which I think is the best way to think about it. You can't go out beyond 5 years because there's really nothing that's predictive. The world changes so much over 5 years. But if you're thinking like 3 to 5 years out, you're also ignoring what's happening in the next quarter or what's happening right now. So Meta's a great example. I own Meta. I owned Meta in the fund. I still own Meta. I like it for those reasons that you point out. Like everybody just got cold on it at some point. Like at one point, Zuck's a genius. At the next point, Zuck's a donkey. And then like, neither of them are true, right? Like he was never a genius. And he's not a donkey, or maybe he's a genius, but he's not a god. He wasn't a god, and he's not a donkey. And you could look at that was still growing revenues. It still earns an amazing amount of money on what's invested in it. As you point out, like if you run a business and you want to go advertising, you really got 2 places you can go. You stick it on Google or you stick it on Facebook, and that's where you got to go. And Facebook got cheap. Like I think when I was buying Facebook, it was about half price under pretty conservative assumptions. But if you read Twitter and if you talk to people, they all know like everybody will tell you why it's cheap. That's not really helpful, man. Like I know why it's cheap. My question is like, what's it going to do in the future? And I like stuff where if this thing gets up in the morning and it puts one foot in front of the other, then it's going to do fine. And I'm going to participate along with it. And even if all of the bad stuff that everybody's projecting happens, it still works. So that's kind of my approach. I think the valuation is simple, right? You just find the simplest valuation metric that you can. That's why I use the acquirer's multiple. It's just super simple. You're making sure you're getting something cheap. And then the job is to go through and find all of the ways that this business is going to get killed. Too much leverage is going to kill a business. Bad managers are going to kill a business. Commodity businesses are a little bit tough because you can't project where their earnings are going to be because they're like an oil company. I do buy them, but I try to buy them when they're really beaten up. That's why I like the acquirer's multiple. It puts you in this stuff when it's really beaten up. In a basket, it's going to be a pretty good bet, but you're going to have periods of time where you get a 20 or a 21. And it was 1920 really. And then the same thing happened in 1999 and 2000. Same deal where basically these companies, for whatever reason, the market just gets like really super bullish about stuff and it just ignores the fundamentals. And so these companies that aren't making any money, but they're going to be, big in the future at some point when they get to this like hallowed ground, they get to the promised land, they're going to make a lot of money then, but they're not making a lot of money now. And they've still got to get there. Like they're not there yet, but they're you're paying a price as if they've already got there and conquered the whole joint, you know. So I try to avoid that stuff. I just try to do the simplest stuff that I possibly can. I want it as cheap as possible, knowing that I'm probably wrong. It's probably cheap for the right reason. But you often also got to rely on the fact that the rest of the market is either too excited or too sort of depressed about these things, and that over time they just revert back to where they should be. And it takes 18 months, 3 years, 5 years to kind of get there. But as long as the underlying business is doing okay, it's good that they stay cheap. You want them to do that. So that's kind of my approach. I think it's very simple. I think the simpler your approach is, the better. You need to then be thinking about all of the ways that the business can be killed. And if you can eliminate all of the ways that you can be killed, then basically all you've got left is just, maybe you just don't do very well. You just bump along the bottom. But I like that because I think every now and again you get lucky and the market just pushes something up. And I think Meta's a good example of that. For whatever reason, it got way too cheap, and then the market just changed its mind, and here it is. It's kind of working again. I still think it's too cheap, but it's working. Now it's kind of going up, so it's getting more attention. Zuckerberg's not such a donkey.
He figured it out.
That's my approach.
Yeah,
He figured it out. Well, he was going to spend all that money on the metaverse, and it looks like that's kind of quietly been shelved a little bit, and he's going to run out of cash.
I remember one of the things that really got me during that time was that people were talking about how much money he's spending on the metaverse, and I'm like, actually, when I read what he's actually spending money on, it's a lot of money, I understand, but comparatively to what Meta's making, they're spending all their money on AI research and building out database centers. That's taking up 80% of the capex. It's not wasted. It's not the metaverse like that. Sure, it's a bet, but that's taken, I don't know what it was, 9-10 billion, whatever it was that he was spending. It's small relatively. I'm like, why is everybody freaking out over this metaverse? Even if this thing goes to zero, Meta's just fine. It just was a bad bet. It's not the end of the world. That actually brings up something that I actually heard this from you in another podcast. When you talked about stopping going short, because in your ZIG ETF, you used to go long and short. Correct me if I'm wrong.
That's right.
And you told me the podcast that you said that you stopped. It's important. You start realizing that you have to survive. And when you said that, I was like, oh, that's it. If I survive long enough, I'm likely to do all right. I just have to survive. I just got to do nothing stupid.
That's it.
If I do nothing that can wipe me out, I'll be all
That's
right.
it. That's what you got to figure out. I think that's the key of the whole thing. I think that's the single most important thing. Once you get that into your DNA, once that's part of the way that you think about things, then everything after that is easy, because you start eliminating all of the dumb stuff that people get blown up with. Shorting is the dumb way to die, and it's possible to do that in the market. Now, I already knew that was that there was a huge amount of risk in it, so I shorted really small. I rebalance regularly. If I'm wrong on something and it's going against me, I just keep on eating my losses. I just take the pain as I go along. I never want to let it get. One of the problems that people have is they short something and it goes against them, and they just keep on. Now the bet is twice as big, and they're just like, all right, now the bet is twice as big, and then the bet is 4 times as big. And it just keeps on going like that. And at some point, you got to take the pain. But my approach was just take a little bit of pain all the time, and not worry about it too much. It was also a basket approach. Having said that, there is still the risk because it's levered, because the upside is unlimited, the downside is unlimited. I just thought it was a better thing not in the fund, and I don't do it anymore anyway. I got this thought, I had this feeling exactly like that if I can just line myself up so that everything that happens in the future, it's either it doesn't affect me at all, or it kind of pushes the businesses and the fund forward, then that's the best way to do it. So that's my approach now. I look for all of the valuations aren't hard. Everybody knows that something is cheap. It's just that everybody thinks that it's justifiably cheap. Meta's the example. Everybody knew why the metaverse was a dumb idea. TikTok is out there. There's a lot of competition, but the thing still earns huge amounts of money, and it still earns huge amounts of money on the money that's invested in it. And it was like one of the cheapest large cap stocks around. So all you had to do was buy it, and then not get too committed. Like you could still be wrong. So don't put like 100% of your portfolio in it, and don't put so much that you can't sleep at night. But I size my thing small. I put 3.5% in. If that goes to zero, so be it. It doesn't bother me so much. Like I'll still survive because I've got 29 other positions that'll work. So I think that's the approach. You just how can I lose here? If you can't figure out how you're going to lose and it's cheap, then put a little position on and then just kind of forget about it and let it go for a period of time. And you either get lucky or you don't. And if you don't, it's already priced like you were not going to get lucky. So you're not going to lose much.
Yeah, you're probably there.
But if you do get lucky, like now the market's got to change its mind.
Oh, there's one thing I was... sorry about that. That's one thing I was considering. Meta is a good example. Another example for me, it's not as cheap as Meta, but it seemed to me to be insane. Like when ChatGPT came out, like Google took this dive, and I was like, do you think Google doesn't have AI, guys? Like really? Like this? Maybe I'm dumb, and I'm probably dumb, right? But I was like, it doesn't make much sense to me. Like Google's been working on AI for a long time, and they've been throwing billions and billions of dollars into it. Like, why are you guys selling me this company cheaper than, like, this is a premium A level, as like it's the best steak you can get in the restaurant at any point in time, and you're giving it to me even at the smallest discount. I was like, damn, that seems like a good deal. Maybe I'm wrong, but it seems like a decent deal.
No, I agree with you on Google. I think Google is probably the best business out there. I don't know how long it stays that way. It may not stay that way, but I think it's the best business out there. And it's crazy to me that it trades as cheap as it does. It's way too cheap, and it's often cheap. I've been following it since it listed in 2004, and because I didn't know it was a great business back then, but I was just kind of interested in it as a business. And they listed by a reverse Dutch auction, which is a really weird way to go public, and none of the VCs liked it. And it was in 2004, which was just after the .com bubble had busted, and tech was really cringe. Nobody wanted to be anywhere near tech. And I was in Australia, and the only to download the prospectus, you had to show that you were in a postcode, in a US postcode, and the only postcode that I knew was Beverly Hills 90210 because of the TV show. So I put 90210 in to download the prospectus to have a look at it. I didn't have any money, but I was kind of like, so I've just followed it since then. So, I've owned it on and off, but I've never owned it in a big enough chunk. But I think it's getting very close to that point where, it's way too cheap for probably the best business in the world.
When I was learning about this stuff, like I remember when I first finished the Columbia Value Investing course. I had been to my beginning accounting course. I was not a good student in school. Like I was not good. I was more of on the wrong side of the school board day thing. Obviously I became a professional fighter. Yeah, I was an athlete and a knucklehead is what I was. I just made that way through school, and so I had to take like accounting courses. Like I didn't understand. I kind of understood business from the standpoint that I had owned businesses before, so there was like some understanding. I'm like, oh, I get this. Like, what matters is what I get to me. Like that was my mentality. I'm like, that's what matters. Like whatever I do, it matters what I can take home. And but I was like, okay, let me look, and I saw a business like Tesla, and somebody had told me, man, Tesla's going to be worth $2 trillion or something of that nature. And it's a data company and so on and so forth. And I didn't understand reversion to the mean at that point in time. And I was like, I think the only value metric I really knew, when I finished, I saw it was the PE was like, I don't know, 100 or I don't remember, something ridiculous. So I went to the valuation method with my course taught, which basically the course teaches you do like an asset value where you try to do like a reproduction value of what the company's assets are worth, which is, for me personally, I'm not the biggest fan of it because it's so hard to actually figure it out. Like, it's a lot of guessing.
I agree.
Like, they got a plant property in Houston, and most Houston properties are at $120 per square foot. It's like, maybe or maybe not. Maybe if we try to sell that shit in 10 years, you're not going to get $10 per square foot for it. Like, it seems to me to be like too much guesstimation. And then the part that I don't mind as much is, does it have sustainable earnings? And basically they take like NOPAT and divide it by the cost of capital, and they say like, oh, that's what it's sustainable earnings if it doesn't grow anymore. And when I got to that part, and then the part after that is to find out the franchise value and to find out what's its distribution yield to, with those two parts I can get along with a little more, even though there's still some guessing involved. But when I saw it, like, I'm like, I don't know if they're sustainable. Like, how do I know that, like, GM's not going to come in and make this? Like, Elon Musk, I love Elon Musk. I'm a huge fan. I hope he does everything because the world be a better place. But he's been saying self-driving cars coming out for 25 years. Like, I don't know if these free cash flows are sustainable. And even if they are, it's selling at such a premium. I'm like, I told my friend, like, I don't understand. Like, I didn't really get reversion to the mean. I'm like, it just seems to me that I'm going to be holding this business, and if it doesn't go anywhere, it can crash on me super hard. And if it goes well, I might not get nothing for it for a long ass time. And when I read your book again, The Acquirer's Multiple, for the second time I read it, I really stuck. I'm like, yeah, it's reversion to the mean. It's exactly what he was talking about. Like, it's going to, at some point, that it kind of is going to come back to that normal level, wherever it is. And it stopped me from making because I would have bought it at basically the top. But it stopped me from making a very big mistake.
Yeah, I'm happy to hear that. So I think I like UFC. That's kind of the main thing that I watch as a sport. And so I've learned, and I've watched a lot. I watched it kind of casually, probably until the pandemic, and then because it was the only thing that was on, I watched it. So now I watch. It's the main thing I watch. It's the only thing I watch. I watch basically all of the fights. So I'm like, there's a lot when you look at a guy like Stylebender. One of the reasons Stylebender's so successful, and I think a lot of the really good guys figure this out, is you don't want to take a lot of damage. Like, Stylebender's very elusive. He's very good at standing outside and just stinging guys from a long way away, and he just wears them down every single time. And I get that he's got Pereira, and that's a completely different kettle of fish because he's so big, right? How does a 228-pound man at 9.8% body fat get down to 185
it's an
for the weigh-in
process? I'm telling you, there's nothing worse than dealing with that. Like, the fight is, sometimes after I weigh in, the fight's an afterthought. It's like, oh, I'm just so happy that I weighed in and I made weight. Like, fuck it.
Yeah.
Like, I'll tell you this.
It's like a marathon before you do the fight.
Especially if you are, like, if you're like an asshole like I was. Like, I'll tell you a quick story before we move on to something else investing-wise. But, like, when I first got in the UFC, so I had fought in China. I fought this American wrestler guy. I beat him in China. I had only got half my pay because the promoter said the fight wasn't exciting enough. This is the kind of shit you deal with in fighting. And I was like, and I go home and I realize my knee's fucked up. And I'm like, man, I don't know if I can keep doing this. I've been fighting for 10 years. I made $1,000. I've been in China in Thailand for the past fucking 6 months. Like, I'm teaching classes. Like, maybe I should quit. And I was actually sitting at home with my cousins on Christmas, and my cousin's like, oh, let's smoke some weed, and we're smoking weed, and we're laughing, and then I get a message. I said, yo, the manager saying, yo, you want to fight UFC in 3 weeks? And I'm high, so I don't really realize, whatever. I'm eating, I didn't even know, I didn't look at it.
So you said yes.
I'm eating cookies, and I go,
over Christmas.
Man, I just got a message about fighting in the UFC. It's like, no, you didn't, fucking idiot. I grabbed it, and I look, and I'm like, oh, fuck, it's for the UFC. I run downstairs. downstairs, I jump on the scale, and it's a weight class above what I'm supposed to be fighting. So I'm supposed to be fighting at 70 kilos. I'm weighing, and I'm normally a 66 kilo guy, and I'm weighing in 86 kilos. And I have 2 weeks to get down and weigh. And I ended up fighting a guy. Right, so basically,
what do you do?
It's basically you're like on
you
a super strict diet. You're water loading because we only got 2 weeks. You're like chugging water all the time. So then, as you're getting closer and closer to the fight, you are expelling more water. And then right before you're going into the weigh-in, this is like a very like remedial version. I'm just quickly explaining it to you. As you're expelling that water, you then stop drinking and you start like doing. Some people do saunas, some people work out, some people go into hot baths, and then you're swimming because your body's been overloaded with water. You've been dieting for, normally this should take like 8-9 weeks period of dieting till you're down to, if you're a big guy, you could be like 20 pounds overweight. If you're like a smaller guy like me, probably at the max you should be like 15, but guys go like 20, especially the more muscle you have, the easier it is. I did not have a lot of muscle at the time. I was fat, obviously. And so like, I like literally before the UFC, I was in the bathtub passing out, like literally fainting in the bathtub. And I was like, my cousin was like, man, let's get him out of here. Let's call this. My friend was like, get him out of here. Let's call this, like, whatever. Just miss weight. Fuck it. But I knew that the chances I win this fight are almost zero because I'm fighting a guy named Mirbek Taishmov. Whenever you got a guy with a Russian and Arabic name, you already got problems starting out. The situation was already problems. And then I'm like, I haven't trained at all, zero up until now for months. And my training was basically trying to throw some punches. I was so weak, it was unbearable because I was just so out of shape. And I'm like, if I lose and I don't make weight, I won't get another fight in the UFC. They're just going to cut me on my first fight out. But so I'm like, at some point though, I'm like in tears. I'm just like grown man in tears. I'm like, I can't deal with it. I got to get out of this bath. And my coach comes. And my coach is a character. He's from Dino Spencer. He's he comes and says, hey, he said, don't worry, man. It's only been 12 years in your life. Quit. Let's go. Come on. We'll get a sandwich. Come on, get out. And I'm like, what do you mean? He said, no problem. Just quit, man. It's cool. Whatever. I said, I love you. Come on, let's go. Let's go get a sandwich. Whatever. Fuck it. Whatever. You quit. Just live with it. And I'm like, I sat there and I made weight. And I ended up getting the only knockout loss in my career during that fight. I mean, no, I'm not shocked. But no. It's a horrible situation. So
what was your background? Were you a wrestler?
But I boxed a lot with Dino. I wrestled a little bit all after. I just started jiu-jitsu. When I started this, I had a dream when I was young. I was like a kid that I wanted to be a pro wrestler like Hulk Hogan and those guys. And I actually went to like a pro wrestling camp. I trained with half of the Wild Samoans. And as I was there, I was like, man, I started jiu-jitsu already. I've been doing jiu-jitsu for a while. I was like, man, these motherfuckers are big, jacked, and tall and athletic. I'm none of these things. I was 265 pounds, 5'6", fat. Like I was just a fat kid. I'm like, they're never gonna hire me in the WWE. But I'm like, I'm really good at jiu-jitsu. I'm a tough kid, and I was a bit of a roughneck when I was young, and I was like, this kind of suits me. I have no problem getting punched in the face, and this is no big deal for me. So I was like, maybe I should switch. I love the UFC. And so I switched, and then I lost. I went all the way down from 165 to 145 pounds, and I became a professional fighter, and I fought for 13 years. It's a great story. It's a crazy story. And now I'm running a fund. So there you go. That's how we switched all this up on me.
That's awesome. That's a great story. Yeah, I look at guys like Volk. Volkanovski was he played rugby league in Australia, and he was a prop, which is like a lineman. He's a pretty small prop, but he's still like a 220-pound man. And I think he
145.
fights at 145 or 135, something like that. He's 145, yeah. I mean, you see how ripped up Volk is when he gets in the... He's chipped up when he gets into the cage.
The funny thing is that I played rugby when I was young, too. I was a prop as well. Yeah, I was a prop, too.
Oh,
I was a prop, but I got injured. I got hit. There was this guy, we called him Meat Wagon. Once he wasn't very fast, but once he started, that was it. Like, once he got momentum. Yeah, once he got momentum.
Oh, yeah, lots of momentum.
Bad idea. And I was the only kid on my team. Everybody else was men. I was 16. And I was like, man, I'm gonna show these guys, my manliness. I'm gonna prove something to everybody. So I kind of tried to tackle him, and he crushed me so much that I tore a tendon in my neck. And I was like, oh, I guess no more rugby for me. That's it.
Yeah, I was just saying I played too. I've got destroyed hips and knees from years of playing. I played rugby. I played rugby until I was 22, and just got destroyed hips and knees from doing it. Yeah. 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 100%. Well, Buffett says the same thing, and I've found the same thing too. The more you get used to dealing with, cash flows and marketing and stuff in your own business, then you start looking at other businesses and you're like, well, that's actually a really clever business, the way that they're doing that in there. And it probably is worth a little bit more. It probably is a little bit more sustainable than other types of business. And then you can look at other things and say, I just don't get it. Like, I don't know how they're making money. I don't see what everybody else sees in it. And because I can't get it, I can't understand it, then I wouldn't know what a good price would be. I wouldn't know what a bad price would be. I should just stay away from something like that. I found it really helpful too. And the longer you do it, that's the nice thing about it. Buffett said this too. And I've found it, I'm 43, but I've been doing it for a while now. I find the same thing. You start thinking about, well, I've seen a few cycles now. I started in 99, 2000, I saw that cycle, and I saw a value cycle come after that, and I saw a crash, and then I've seen a tech cycle again, and we've seen it crash. I think we're probably halfway through. I think we've got a little bit more to go, and then we'll probably go back to more of a value fundamental type cycle after that, which is better for guys like me and you, better for guys who are able to kind of think through the business and think of it more like a business than kind of like a thing that you're trying to sell to somebody else all the time. Like, I think that's another one of the big keys is people often buy these things thinking that they're going to sell it, to the greater fool. Even if that's not really what they're thinking that they're doing, they're still thinking in those terms. They're like, at some point, this is going to be worth more. Whereas I think the best way is just, it's undervalued now. Like, you're baking in the return that you're going to get at the price that you pay. And you can see the return that you're going to get from what the thing is earning and what it's doing with those cash flows, if it's paying them out or if it's reinvesting them in the business. And because you've done it in your own business, you understand it more in with what they're doing. And so you can see where it can get to in the future. And you should be conservative in your assumptions and all of that sort of stuff. But I sometimes look at these things and I think it's just crazy the price that you're getting this for. And Meta was one of those examples. Like, for what is an amazing business at the price that you could get it for, if the business just does its thing for a while, you're going to do very well. And so that's the kind of opportunity that I want. Nobody is arguing about the valuation, right? There's nobody who thinks that the valuation on the historical figures, nobody thought that Meta was cheap, or nobody thought that Meta was expensive. What they were thinking was, there's TikTok and there's the metaverse and all these other things, and you've just got to handicap that a little bit. And if you can handicap them, then I think you do okay. And that's basically my approach. I always want to simplify it down. Like, just keep on simplifying until you get to the point where you can really see how everything in the business works. And that's when you're going. What's happened, mate? We lose connection? Still recording on my end. Yeah. Yeah, so I was a lawyer and I had been working as a lawyer. I worked in Australia and the US. I worked in San Francisco in tech M&A, mergers and acquisitions, which is helping companies buy other companies and sell other companies and all that sort of stuff. So it's kind of similar. It's a little bit similar to what I do now. But I didn't want to do that forever. I wanted to be an investor because I just found it more interesting. It was what I really liked doing. And so I went and got a job I worked in another guy's fund for a while just to sort of understand what he was doing. And then I tried to set up a little partnership and I raised some money had some wealthy friends who put some money in, and I had a little bit of savings and I put that in. It was not very many investors in it. And I started that in April 2010 and I ran that until I came to the States. So I started that in Australia, then we moved to the States with my then girlfriend, now wife. We got married, and then I tried to get a job in the States, but I've got Australian degrees, and it was too hard for me I couldn't get picked up. So I had to work out what I could do to sort of talk about what I like doing. So I started a blog. I just started this little blog called Greenbacked, and it was just looking for nets. So for people who don't know, that's the Benjamin Graham, who's like the father of value investing. He wrote a book where he talked about buying these companies for less than the net current asset value, which is basically the most liquid part of the balance sheet. It's like cash, inventory, and receivables, and then discounting all of the other liabilities in the business. And you get this little residue, which is the net current asset value. And then you try and buy at a discount. You try to buy, for every dollar of net current asset value, you don't want to spend more than 66 cents in stock price. So it's called a net because it's net of the net current asset value. Historically, the returns to it have been very good, but there just aren't very many of them around. They're very small. They're very thinly traded, and you've got to be used to volatility. But the good thing about it is it teaches you that what drives the returns is the discount to the value and not the quality of the business, because they're all shit businesses and they're all terrible balance sheets. Like, that's why they're trading so cheaply. But if you do that and there are activists who come in and buy positions in these things and try to get them to pay out their cash or do something with the business to kind of get some attention on it, and then you get pretty good returns from that. So my whole strategy was just to find something that was a net with a 13D file. So a 13D filing is the filing that an activist investor has to put on to tell what they're going to do. And they often write a letter. They just write a letter that tells the company what they think is wrong with it, what they should do to fix the problem. And so I had some pretty good success with those kind of positions. And I was writing about them on my blog. I'd get the 13, I'd do a little valuation, and then I'd get the 13D letter, and I'd just say, this is basically my entire thesis. Like, it's undervalued on like a liquidation value. Like, if this business gets busted up and stopped, you still make money in this business. And this activist in there, who's a professional investor who knows what they're doing, is trying to make that happen. So you got something happening for you. But then I pretty quickly realized that the universe of stocks where you can do that in is very small. And it's hard to sort of manage a business, like a fund management business, investing in those kind of positions, because they're just too small. You'll never get too big. You get really good at it and you'll raise money, and then you just won't be able to do it anymore. So I looked for something that had the same kind of theory to it, where it was very, very undervalued, but I was looking for a different way of assessing the undervaluation. And when I was at uni, I used to go and sit in the business library, and they had these old periodicals where the periodicals used to be like, now everything's on the internet, but back then they came in like a physical format, and you had to sit down and read through these things. And nobody ever looked at these periodicals because they were 20 or 30 years old. They just kind of sat there. And so I just sit in there and just read through. And one of them talked about, in the 1980s, when the takeovers were, like, they were doing a lot of LBOs and a lot of takeovers, when all of that stuff was going on, they talked about this thing called the acquirer's multiple. And it was basically what I call my acquirer's multiple: EBIT on enterprise value, operating income on enterprise value, EBITDA on enterprise value. And they described the philosophy of it. They're just trying to find stuff that's too cheap relative to how much it's earning. And I realized that you could use that over any company in the stock market. You could look at it and you could rank them all, and you can get these reasonably big companies that are trading way too cheaply. And you get, like, Apple has been in my screens 3 times. It was in there in 2013, it was in there in 2016, and it was in there in 2019. So these really big, really good companies do get too cheap sometimes. When it was in there in 2013, Carl Icahn showed up and he said, you've got to buy back stock. And David Einhorn was in there saying you should issue these things called iPrefs, which were like preference shares that had the same effect. And so I thought, this is a good approach. There's a good professional investors wind up in the same stocks that you're in. So that means that Icahn thought it was too cheap, Einhorn thought it was too cheap, and Buffett subsequently bought it in 2019 when it didn't quite come into my screen, but it was very close. It was just sitting on the outside, and that was when Buffett put his gigantic $40 billion position on. So I thought, well, this is a this is a really good approach because it's putting me into the same stuff as investors who I admire, like Buffett and Icahn and Einhorn. But I was figuring it out by myself. Like I wasn't following them in. I was kind of getting in there a little bit before them. So I thought, well, this stuff works. It's still that same. You're buying the stuff at a big discount. You're relying on the fact that eventually the market figures it out, or because they're so cheap, they do something like they buy back some stock. And then people say, oh, well, it's not dead. Maybe it'll keep on working. So I had that. I wrote that down I had it on the blog. I wrote some books I did some research with a guy who was at Booth, which is a good quant school here, Wes Gray, and I went and found every bit of academic and industry research we could, and we wrote a book called Quantitative Value, and that was basically taking out any of the, you and I can argue about whether a business is good or not, but ultimately we can put it to this acid test of how does it look quantitatively, and then we can argue about, what does the future hold for this business, but now we're agreed on the value, right? We're just disagreeing on what's going to happen in the future. And so I like that approach. And so after I'd done those things, I set up acquirers. I had this, as I was writing Quantitative Value, I realized that the acquirers multiple was kind of a good idea that was a little bit like the magic formula. So David Einhorn, Joel Greenblatt has the magic formula. And I was like, this is like a better magic formula, but it's even simpler. And I know that it works. And so I'll write the book up. And I wrote the book, created the website. I built all that stuff myself. And I got contacted by people all the time who are like, it's actually really hard to manage these portfolios because there's a lot of buying and selling and rebalancing. If you set up a fund, I would invest in it. But they were smaller investors, retail type investors. They're like, I'd put 20,000 or 50,000 or 100,000 in. And so then I realized that the only way that would work was in an ETF structure. The problem with the ETF is they're expensive to set up and they're expensive to run. So it took a long time sort of talking to people who were bigger investors, and I finally found someone who would seed it for me. So someone who would put in $2.5 million to get it going. And then I just sort of talked about it on podcasts like this, and it's grown over time. And I sort of, I had the epiphany kind of in the middle of COVID, like in about September 2020, that, nothing was working then. My strategy of value was definitely not working. But I realized that that's happened many, many times in the past. It happens all the time. You go through long periods of time where your stuff doesn't work. And that was when I realized that if I survive, if I get to the other side of this, there's a good chance that this stuff turns around. So that was when I had this whole philosophy. Like I just realized the most important thing, all we've got to do here is survive. And that's always true in the market because better times are coming. So then I got rid of the shorts and I've just gone into this full on, I'm just crazy about survival. It's the only thing I really care about. So I make sure that the companies that I'm invested in can survive. I make sure that I can survive. I make sure the strategy survives. That's how I approach every problem now. How do we get to the other side? Knowing that if we survive, we will get a good market for us. Like my strategy will have a very good run at some point in time in the future. I don't know when. I don't know how good it'll be. I just know that the cycles come and go. There's the mean reversion of the market. All you've got to do is be there when it happens. And I've seen so many people who give up at the worst time for their strategy because they just can't take it mentally. Like it's not that some of them lots of people get blown up. Like most people get blown up, but there are lots of good investors out there who mentally they can't take it because it's just so wearing. It sucks losing all the time. It just sucks waking up every day and losing, and they just can't take it. Like I have a really good friend. He's just shut down a thing that he's been doing for 10 years because he was just suffering so badly in the. And I just realized that basically if you can get to the other side, if you survive, you're going to make it. So that's my philosophy these days. The valuation is less important. All of the other stuff is less important. Provided you survive, you're going to be okay. That's my theory.